Adjusting journals. Accrual-based accounting records revenue when it is earned and expenses when they are incurred. This is deemed more accurate than when cash is paid or received for a good or service. However, it can make recording journal entries rather difficult. There are 4 types of adjusting journal entries. We have deferred revenue, accrued revenue, deferred expense, and accrued expense. Deferred revenue is when cash is received before revenue is earned. An example is if Katie's Cakes receives an order on the 1st of January for 50 cakes to be delivered on the 15th of each month for the next 12 months. The total cost of $12,000 is paid up front. Remember that deferred revenue is a liability because we have been given money but we still owe a service to our customer. This would look a little like this. We would debit cash $1,200 and credit unearned service revenue $1,200 as well. If at 30 June we prepare the financial statement, since we have now delivered half of the cakes, we must do an adjusting journal to account for the amount of revenue that has now been earned. We would debit unearned service revenue $600 and credit service revenue $600 in order to account for the 6 months of revenue earned. Is accrued revenue, which is when cash is received after revenue is earned. On the 1st of March, Katie's Cupcakes agree to provide 100 cakes to bill for $500. They send out the invoice the following day. Note that accrued revenue is an asset since we have provided a service but now we are owed money from our customer. Therefore, we will debit accounts receivable $500 and credit service revenue $500 in order to account for the revenue that was earned in March. Now, on the 14th of March, Bill sends a check for $500. So we debit cash $500 and credit accounts receivable to account for the receipt of cash for the service that had previously been provided on credit. Now for deferred expense, which is cash that is paid before the expense is incurred. Katie's Cakes rent a shop on George Street. On May 1st, Katie's Cakes pay $600 to their landlord in advance of the next 3 months. Note that deferred expense is an asset because we have paid for the expense before it has been incurred. So we debit prepaid rent $600 and credit cash $600 for the purchase of rent. On the 30th of June, the financial statements are prepared and an adjusting journal is recorded to account for the amount of expense which has been incurred. So we debit rent expense $400 and credit prepaid rent to record the expense incurred. Now we have accrued expense, which is when cash is paid after the expense is incurred. Katie's Cakes have 3 employees who are each on a salary of $3,000 per month and are paid on the last day of each month. On the 15th of April, the statements are prepared and an adjusting journal is recorded to account for the expense that has been incurred, but not yet paid. This is a liability because we have been provided with a service which we have not yet paid for. We would debit salaries expense $4,500 and credit salaries payable to account for the salaries that have been incurred over the month.